There's a war happening thousands of miles away, but believe it or not, it's silently reaching right into your pocket. It doesn't matter if you've ever bought a single stock, because your petrol prices, your grocery bills, even your savings are all on the front line. So let's follow the money and see exactly how this conflict is finding its way into your wallet. You've probably felt it already, right? Prices are just creeping up, and what you could buy yesterday suddenly costs more today. Well, I can tell you this isn't a coincidence. It's a direct financial shockwave traveling from a conflict zone straight to you. Let's trace it back to the source. It all starts with one thing: oil. Before this whole conflict kicked off, Brent crude oil was sitting pretty at around $73 a barrel. Now, it's shot up to over $108. I mean, that's a massive 48% jump in just a few weeks. And since oil literally powers everything from the car you drive to the trucks that deliver your food, when its price explodes, everything else gets more expensive. Now, this global oil shock hits the Indian economy particularly hard. See, oil is traded in US dollars, so to pay for our fuel, India has to buy a whole lot more of those dollars. This massive demand for dollars weakens our rupee, which just hit a staggering all-time low of over 92 rupees. And what does that mean? Well, it makes not just oil, but everything we import way more expensive. And for investors, wow, the impact has just been brutal. In just 23 trading days, over 47 lakh crore rupees of value has been completely wiped from the Indian stock market. That is not just some number on a screen. That's a tangible loss being felt in retirement funds, in savings, and in investment portfolios all across the country.
So what on earth is causing all this chaos? You might be thinking it's some super complex global conspiracy, but honestly, it boils down to one single tiny spot on the map: a critical waterway that's become a choke point for the entire world economy.
This is it, the Strait of Hormuz. It's just a thin strip of sea, but, and this is no exaggeration, it is the most important oil highway on the entire planet. And right now, because of the conflict, that highway is effectively closed for business. Just to give you an idea of how big a deal this is, get this: a full 20%, that's 1/5, of the entire world's daily oil supply passes through that one narrow strait. Taking that offline is exactly what's creating this massive price shock. For a country like India, which gets half its oil imports through here, it's nothing short of a catastrophe. Okay, here's the best way to picture what's happening. Imagine the main highway into your city gets completely shut down. Every truck, every delivery, every single supply gets backed up for miles. The few things that manage to get through on back roads suddenly become incredibly expensive. That is precisely what is happening to the global economy right now. So this one little choke point, it's setting off a global market meltdown. The effects aren't just localized. We're talking a financial shockwave that's being felt in trading hubs all the way from New York to Mumbai. So let's get the timeline straight real quick. It all began back on February 28th with the first airstrikes. Within the very first week, the Strait of Hormuz was shut down. And now, just 4 weeks in, we are seeing the full extent of the market chaos this has unleashed. Even the United States, the world's top oil producer, isn't immune. The S&P 500 is down 6%, the Dow Jones is down 9%. But look closer, it's a really interesting story. While airlines are getting absolutely crushed by high fuel costs, defense stocks and big oil companies are seeing massive gains. It's a perfect illustration of how a crisis creates both huge risks and big opportunities in the market. And here in India, this split between winners and losers is even sharper. On one side, you've got the sectors that are just crippled by high oil prices. We're talking airlines, auto manufacturers, paint companies. They're all taking a huge beating. But on the other side, the winners are just as obvious. Defense companies like HAL and BDL are surging, along with oil producers like ONG, and of course, the classic safe haven, gold. Okay, so that's the problem. It's a lot to take in. But what do we do about it? This isn't about trying to predict the future. It's about protecting your finances with a clear strategic plan. So here are 5 steps you can consider to defend your portfolio right now. All right, here's the playbook. It starts with the most important rule of all: don't panic. From there, we'll look at how to shift to safety, how to strategically rotate between sectors, and how to use the power of disciplined investing to your advantage. Let's break it down. And step 1 is by far the most important. You do not panic sell. Seriously, let's look at the history books for a second. This data shows that after the last 6 major geopolitical crises, the Sensex didn't just recover, it roared back, averaging an incredible 38% return within 6 months. Selling at the bottom is very often the biggest mistake you can make.
All right, so if you're not selling, where do you find a little bit of safety in this storm? Well, here are your classic go-to options. Gold has been a store of value for thousands of years. It loves uncertainty. The US dollar often gets stronger as investors around the world look for stability. And hey, while they won't give you spectacular growth, government bonds and good old-fashioned bank FDs are designed for one thing: to protect your money. Step 3 is where we get strategic. It's called sector rotation. And it simply means shifting away from industries the crisis is hurting, like airlines and auto, and moving towards those it's actually helping. That means looking at defense, energy, and steady utilities. It's all about adjusting your sails to the wind, not trying to fight the storm.
Now, this next one is for anyone out there with a systematic investment plan, or SIP. The big rule? Keep it running. I know it feels wrong to keep buying when the market is falling, but you're actually getting everything at a discount. This is rupee cost averaging in action. By investing that same fixed amount, you automatically buy more units when prices are low, which dramatically lowers your average cost and sets you up for bigger returns when the market eventually recovers.
Okay, so we've got a defensive plan, but what's next? What should we be watching for on the horizon? Well, the path forward really depends almost entirely on one single thing: how long this conflict lasts. Basically, it looks like there are 3 main paths from here. If the war wraps up in the next few months, we can probably expect oil to stay high and the market to recover slowly. But if this drags on for 6 months or more, that's when the risk of a real recession becomes very serious. On the other hand, any real news of a ceasefire could trigger a very, very sharp and powerful rally. So when you boil it all down, what's the big takeaway here? It's that what we're facing isn't just a military conflict. It's really an energy and supply chain crisis that's showing up as a market downturn. The daily headlines are going to be full of panic and noise. Your strategy shouldn't be based on that fear, but on the clear lessons of market history.
And that leaves us with one final question to think about. During a moment of extreme market stress like this one, what do you believe is the greater risk? Taking decisive, strategic action based on a plan, or taking no action at all and just hoping for the best?